Today, we're going to be talking about how you can invest tax-free with RRSP. And if you have no idea what I'm talking about, and if you don't use RRSP today, don't worry, I'm going to explain everything. Just stick around to the end of the video. And if you use RRSP today, keep on doing that, keep using it. I'm going to show you all the not well-known features and benefits and also drawbacks of RRSP that every single person has to know. But before we start, if you are enjoying the videos, don't forget to smash the like button, subscribe to the channel. I post videos every single Sunday. Welcome to the club, and let's go. So what is RRSP? It actually stands for Registered Retirement Savings Plan. And it has a savings name in it. I know it's a little bit confusing, but it's actually a fully qualified investment account. It's a very similar one to the TFSA that I talked about in my previous video. You can go and check it out. But it has some other features to it. We can call it a tax shelter account, but even more appropriately, it's going to be our tax deferred account. Basically, what it means is that all the gains you're going to be getting from your initial investments on your RRSP account, like dividends or share price appreciation and all that, are going to be tax-free. And the tax deferred part comes into play when you actually start using your money from your RRSP account. I'm going to be talking about it later today. Let's wait for that and start with the simple stuff first. Overall, RRSP is a fully qualified investment account. As talked about, it has all the features of being an investment account. You can buy stocks, ETFs, everything with it, right? You can actually start using a mutual fund where your investment is going to be managed by some other brokers, or you can use robo-advisors with RRSP as well. That's probably fine. Or you can do what I'm doing and self-manage all your investments on your own. Let's take a quick example now and see what the tax shelter part means of your RRSP. So say you bought one share of Microsoft with your normal, regular, non-registered account, right? And say you paid $100 for it. Now, a couple months later, say the price went up and now it costs $200. So you basically gain $100 on top of your initial investment. Now you actually owe taxes on your gain, right? It calls capital gain. And how is that calculated is actually you divide that by 50%, so you only pay taxes on the 50% of your gain. So in our case, it's going to be $50. And this $50 gain is going to be added to your full yearly income, and depending on your tax bracket, that's how much taxes you're going to be paying. But now a different situation where you said you did the same investment, a single share of Microsoft for $100, but you bought it through your RRSP account. And now you also gain $100 on top of your initial investment, so your gain is $100. And there are no taxes, so you're done. Your account is now $200. You don't owe any taxes on that. It's totally tax-free. But then when the retirement comes, and I'm gonna cover that a little more in detail later on, when you actually start using your money from your RRSP account, then you're going to be paying taxes when you're actually withdrawing money from your RRSP. Also depending on the tax bracket you're in at that age. And all this initially means that you can save money on taxes right away. And over the long-term period, your compounding will skyrocket even faster. You're not going to be owing taxes to anyone. You're going to be paying dividend taxes and all that. You're going to be reinvesting back all that. That is why it's a perfect account for long-term investments. Now let's cover that tax deferred portion and what actually happens when you actually start withdrawing money. And before even looking into that, we're going to be touching on what actually the limits for your RRSP. Yes, and there are limits of contributions. You cannot just pour money into it limitless, right? Because everyone would do that. And the limit right now is 18% from your previous year income. And there is a limit on that as well, which is capped at $27,830 for year 2021. And it actually increased in 2022, which is now at $29,210, which means that your yearly income for the 2020 should have been actually at $154,000 approximately to get the maximum amount limit on your RRSP for 2021. Now for 2022, the limit increased up to $29,000 approximately. And that puts you on a spot that for year 2021, your yearly income should have been at $162,000 to get that maximum amount on your RRSP. And you don't have to earn that money. It just means that the limit that you can put on your RRSP is capped at that amount. And an important point here where people ask a lot of questions is that what this limit represents. And it's actually a contribution limit or the deposit limit, right? Or how much money you actually deposit to your RRSP account. So for example, if your limit is $10,000 and you deposited today $5,000, then in a couple months later, your investments actually grew and you now have $10,000 in your account because you bought right stocks and right ETFs. And a couple months later, it became $100,000. And it doesn't mean that you approach your limit, right? It only means that your investments actually grew and all that money is yours, right? But you still have $5,000 from your initial contribution limit that you can put onto your account. So that is great. So this contribution limit is actually the limit that you can deposit to your account. I really hope this is very clear, and if you have any questions, of course, let me know in the comments and I'll try to answer to the best of my abilities. Now moving on, if you don't actually invest all the limit you have for the year, don't worry about it. It will actually add up to the next year. And so if you don't invest to your RRSP, you still have this RRSP room. You can check out your limit on your notice of assessment. It's going to be all the way at the bottom saying like RRSP limit or RRSP contribution limit or some sort of that. And it will always add up to the next year, right? So don't worry about that. Make sure you prioritize TFSA first and only then you go to RRSP. And now a different example, what if you actually over-contribute to your RRSP and you go beyond the limit, right? So the limit is say $29,000 for you and you invested $30,000. What's gonna happen then? There are penalties associated with this over-contributions, but there's a catch. If you over-contribute up to $2,000, there are no penalties for that. So this is something that you probably should know, and not a lot of people know about that. But if you go beyond that, then you're going to be charged 1% fee every single month on the amount you actually over-contributed until you fix that. Watch out for that. Don't over-contribute. Always calculate your room and only put money that they actually allow you to put in there. Now the next important point, how this contribution work and how you can save on taxes. So the way the RRSP account contribution works is that it's after tax contribution. And what it means is that you're getting your salary bi-weekly and this salary that you're getting is after tax salary. You already paid taxes for that. And your employer also paid some taxes on that amount, which means that if you are depositing to RRSP account with your after tax money, then when the tax season comes in and you need to file your taxes, you actually deduct your contributions from your yearly income. And you basically lower down your yearly income, which means you are lowering down your tax bracket, and which also means that you owe less taxes. So the CRA, the Canadian Revenue Agency, is going to calculate how much money you actually earn throughout the year, also accounted for your RRSP contributions, and how much taxes you actually paid through your salary checks, right? And if you overpaid your taxes, they're gonna actually refund you back with your money and you're gonna get tax back, which is great. This is exactly how you can save money on your RRSP contributions. And it's the perfect conditions for your investments as well, because when you put money on your RRSP account, you invest that money. So that already starts growing and you get this share price appreciation or you get this dividends from your investments and all that. But at the same time, you file your taxes and you get a tax refund. So, it's a win-win situation. Why wouldn't you use that? It's a perfect account for everyone in Canada. Everyone has to use it. And now we are finally moving on to the tax deferred part, when you actually need to pay taxes. So basically, you're contributing to your RRSP throughout your prime time. When you're in high tax bracket, you're powerful, you work, and your income is very high, right? Then when you are getting closer to retirement, then you are probably not work as much, right? And you only worry about where to go, how to travel, spend time with your kids, grandkids, and all that. That is why when you're in your retirement age, then your tax bracket is lower. And again, it's not applicable for every single person. Not everyone's going to be in the lower tax bracket when they retire, but on average, statistically, this is how it works. This is how it's going to be. And then at the age of 55, you can start converting your RRSP to RRAF. And it's a one-way decision that you cannot go back and convert it back to RRSP. What it means is that if you start converting your RRSP to RIF, then it's final. You cannot longer contribute to your RRSP account. You can only start using it without extra penalties, extra taxes on your withdrawals. And you have to withdraw everything when you hit 71 years old. And at that time, the money is going to be converted to RRIF. So again, you can start pulling money off from your RRSP at the age of 55, which means that you can start using your RRSP investments starting at 55 years old. And now this is when the tax deferred part comes in, so you're going to be paying taxes on your withdrawals from your RRSP account depending on your tax bracket at that time, because your withdrawals are going to be actually added to your yearly income at that age. So make sure you calculate correctly how much taxes you're going to be actually paying on your RRSP withdrawals, and if you maybe want to wait out a little more when you actually stopped working on your regular 9-to-5 job and only rely on RRSP. Now, it doesn't mean that you can only start using your money when you are 55 years old. You can actually start using your money earlier. For example, there is a first home buyer's plan, which means that you can withdraw up to $35,000 from your RRSP tax-free, completely tax-free, and use it to purchase or to put into down payment for your first home. There are a couple rules what this first home means, that it has to be your primary residence. They're all defined on Canada.ca website. I'm gonna link it below in my description so you can check it out if you want to. But this is a great tool for buying a house, and you have to pay back all that money, all $35,000 within the next 15 years. So it's sort of like a tax-free loan from your own investments, right? So that's very interesting, but that's the way it works. And the final option is that you can actually withdraw money from your RRSP account whenever you want. But there are fees, there are penalties associated with that. And it depends how much money you actually want to withdraw from your RRSP. But in any case, the withdrawal tax that you have to pay for your investment is actually pretty high. It goes all the way to 30%. Again, depending on how much money you want to withdraw, right? Also, that amount that you withdrew from your RRSP is going to be added to your yearly income, and your tax bracket might go up, so you might end up paying even more taxes for that year. So really watch out for that. If you really want to do it, make sure you calculate everything and you make the right decision before you withdraw your money from your RRSP before you're getting 55 years old. Now the final part, which is very important for RRSP and also for TFSA, that I want to remind everyone here, and maybe not everyone actually knows about it. And this is going to be with regards to dividends and how dividends are actually taxed on your RRSP account. So if you invest to Canadian stocks, dividend stocks, or US dividend stocks on NASDAQ, New York Stock Exchange, you're not going to be paying any dividend taxes on your investment through RRSP account. So that's because Canada has an agreement with US that this withholding tax is actually not there. But now if you do the same thing with your TFSA account and invest into dividend stocks on US stock market, then you are going to be paying withholding tax on your investments through TFSA on dividends, which goes all the way to 25%. That's a very important topic that you need to know about and you need to watch out for. Now back to RRSP, Canada has an agreement with United States, but we don't have any agreement with other countries. So if you're investing into dividend stocks outside of Canada or US, you are going to be paying dividend taxes, which is roughly 15 to 25%. So watch out for that. Basically, don't invest into dividend stocks outside of Canada or US on your RRSP account. And a lot of people just ignore that because it's not a very well-known information, but it's gonna eat up a lot of your investments going forward. So make sure you put your stocks into right accounts and your dividend ETFs into right accounts whenever you're doing your own investments, right? And also make sure you look at your robo-advisor accounts and see what the investments you have there, because not all the robo-advisors actually account for this withholding tax with their calculated investments. So that's about it for RRSP. I really hope you enjoyed this video. I really hope you learned something from it. And I hope you are going to be using your RRSP account or actually using it today. This is a very important account for especially a high earners because your tax bracket is going to be lowered, tax backs and all that. And I personally use both TFSA and RRSP accounts and I really like them. So don't forget to smash the like, subscribe to the channel, and I'll see you around. All the best there. Cheers, bye.